So I'd like to invite the panelists up onto the stage to join me. And we have Mr. Zeno Ebenoya, Deputy Governor from the Central Bank of the Philippines. Mr. Minzu Kwon, Deputy Governor from the Bank of Korea. Ms. Alicia Garcia Herrero, Chief Economist for the Asia Pacific for Natixis. And Mr. Arup Ghosh, Chief Rate Strategist for ASEAN and Korea at Standard Chartered. Please, a round of applause for our panelists. Now, the topic for this session is implications for monetary and financial stability of the changing global financial landscape. And I think this is a topic that flows very naturally from the discussions that we've had so far today, and I think is a very appropriate way to round out the day. Now, as I mentioned earlier, the session this morning highlighted how on the one hand we have increasing fragmentation of the global economy, but on the other hand, when we look at the ASEAN +3 region, in many respects we see ongoing tight, in fact, potentially even tighter integration of the economies there. We then heard from Julia Leung and Hyung Song Shin that when we look at finance at the global level, we're not seeing fragmentation. In fact, we're seeing increasing integration and linkages there. Now, this integration brings benefits in terms of helping global capital to flow to more productive uses, and that's particularly important in an environment where jurisdictions have very different demographic profiles, very different patterns of saving, potentially very different investment opportunities, very different outlooks for productivity growth. But as always with financial flows, there are risks involved, and Hyun highlighted very well, I think, some of those. This, of course, is an aggregate story, but to really understand what's going on, we need to look beyond these global aggregates, look at individual regions, individual jurisdictions, home in on individual financial markets and products and institutions. And I should say that this session is about changes in the global financial landscape as a whole. And when we're looking at the ASEAN +3 region, you need to go beyond financial markets and also consider developments in payment systems and technologies, which is an area where, as we heard this morning, this region is really at the forefront. So we have lots to discuss. There are many questions, and I'm not the person to ask to answer those questions. So we should move on to the panel. Now, in terms of formats, I'm going to ask each of our panelists to give some opening remarks. To provide some structure for that, I've asked each of them to speak about what they see as the most significant changes in the ASEAN +3 financial landscape over the past 5 years, or what they think will be the most significant changes over the next 5 years. And after that, we'll move on to the question and answer session. We'll go from left to right. So Zeno, over to you.
Thank you, Daniel. Again, thank you to AMRO and BIS for inviting us to this forum. There are indeed a lot of developments right now that is affecting performance of individual economies in the region. For one, the change in the attitude towards trade, international trade, has been a major focus in discussions right now, and that debate could last for a long time. So the issue on economic fragmentation could be with us for some time. We've seen it affect real outcomes in different economies, but it may also eventually see itself in the functioning of financial markets. For the most part, we have seen some economies building some resiliency to this economic shock so far. For example, there have been front-loading of some of the economic activities. The technology cycle is still there, and that has helped prime economic activities so far. And at the same time, if you look at financial markets, we are trying to understand whether they have already incorporated a lot of the implications of this economic fragmentation. If you look at Philippines, for example, the CDS spreads for Philippine sovereign instruments have gone up, but not so much given the increase in policy uncertainty, the anticipated economic shock. That hasn't been seen in some of the financial market indicators. So I think that that's one trend, economic fragmentation, and how that could be incorporated or digested by financial markets. There were lots of discussions on emerging technologies and their implications on the banking system, how they operate, how they adapt these technologies. So probably that is also one trend that could have implications moving forward. And then finally, related to that, the talk about tokenization, stable coins. We are trying to understand what that means moving forward. So in some sense, there's this visioning exercise of what the world will be 5 years from now. Will some private sectors have gone ahead? Where will governments, national government, position themselves? And central banks at the heart of the monetary system and the payment system, how will they evolve in this world that we see that is fast evolving? So we think some of those, these are some of the things that we are looking at right now.
Thank you, Zeno. And I think that was a very nice stage setting, giving an idea of sort of the potentially enormous changes in the financial landscape in this region that are currently going on. Now, I'll ask Minzu to give his thoughts, and understand, Minzu, you'll be focusing in on sort of one particular aspect of changes in the financial landscape in this region.
Thank you, Dan. And I would like to thank AMRO also for having me here today. The biggest buzzword in Korea nowadays is stablecoins, whether we should issue Korean won stablecoins or not, and also whether who should issue these stablecoins, non-bank institutions or commercial banks. So I think it's a meaningful time for me to present to you today that what Bank of Korea is thinking about and how we are balancing between this innovation and trust in issuing Korean won stablecoins. So I prepared some slides, so I will go over the slides with you today. So I will talk about opportunities and challenges in stablecoins. So put it simply, stablecoin is a form of private issued money that uses new digital technology. So the essential question here is this: can private sector innovation successfully improve the way money works? Or will it create new risks that traditional central bank managed money has historically helped us avoid? This presentation focuses on both sides, the opportunities and challenges, and how Bank of Korea is approaching them. First, let me start with the opportunities. Stablecoins offer clear technological innovation. They are issued and transferred on blockchain rails, a system that operates globally, anonymously, and 24 hours a day. Because they are programmable, stablecoins can embed conditions for payments. Stablecoins can also streamline cross-border payments. Instead of going through multiple intermediaries, individuals could send money overseas with just a few taps on their smartphones, faster and at a lower cost. As more assets are tokenized into small digital units, stablecoins could become a key means of settlement in this new environment. However, there are also major concerns. If stablecoins are issued by private companies, can they really maintain the promise of one coin equals one Korean won. This promise depends entirely on the issuer's reserve assets and operational capacities. History gives us warnings. During the US free banking era in the mid-19th century, many banks issued their own notes. Because each bank held different qualities of state bonds as collateral, the banknotes were not equal in value, even if they had the same face value. This shows that the money is not just about technology, it is about trust. So ultimately, the question is not, is the technology possible, but rather, is reliable trust possible when issuance is decentralized? So let me now explain the key risks Bank of Korea sees. The first risk is depegging, the loss of stablecoins' price stability. Even the top two global stablecoins have shown price volatility when market stress occurs. Non-US dollar stablecoins have shown, as you can see in the chart, even larger fluctuations. A well-known example occurred in early 2023 when USDC temporarily fell to 88 cents after Silicon Valley collapsed. The issuer's reserves were partly held at the bank, and once trust in the bank faltered, the trust in the stablecoin fell as well. So why depegging happens? This volatility happens because stablecoins operate outside the central banking framework and therefore do not satisfy the principle of singleness of money. With bank deposits, 1 Korean won in Bank A is always equal in value to 1 Korean won in Bank B because both are fully backed by central bank money within the payment system. Stablecoins, on the other hand, differ by issuer, by their reserve composition, their risk level, and their governance. As a result, one stablecoin is not always equal to another, and maintaining a stable price becomes very challenging. The risk number 2 is coin runs. The second major risk is coin runs, which is digital age bank runs. Even if an issuer holds 100% safe assets like government bonds, runs can still happen. Bond prices fluctuate, and in moments of stress, investors may rush to redeem at the same time. In a digital environment, trust can collapse at unprecedented speed. With a single click, millions of holders can attempt to redeem simultaneously. This could trigger forced selling of reserve assets and spill over into traditional financial markets much faster than classic bank runs. Third, we must consider consumer protection gaps and regulatory challenges. If an issuer fails to honor redemption, stablecoin holders are not protected by deposit insurance laws. And because issuers operate outside the central bank system, the central bank cannot act as lender of last resort. And also, blockchain's anonymity increase the risk of money laundering. According to chain analysis, 63% of illegal crypto transactions in 2024 involved stablecoins. For Korea, another concern is capital flow management. Korea monitors foreign exchange flows for economic stability, but stablecoins can circumvent existing regulations. While blockchain transactions are traceable, identifying the people behind them is extremely difficult. All of this raises questions about how to align stablecoin rules with existing capital and FX regulations. Other concerns include shrinking bank deposits and thus reduced lending capacity, and weakening monetary policy transmission. So what should we do? I will introduce POK cases. So given these risks, the Bank of Korea position is clear. We must build a strong institutional framework so innovation can grow safely on a foundation of trust. So first is a bank-centered issuance model. If a Korean won stablecoin is introduced, Korean banks should be at the center of issuance, either as the issuers themselves or through a consortium led by banks. Banks already operate under strict capital and FX rules and have the governance culture needed for compliance and financial stability. This makes coordination with monetary and financial policy much easier. Non-bank tech firms can still participate by joining bank-led consortia. Second, a cross-agency policy committee is crucial because stablecoins have implications for monetary policy, capital flows, and the broader economy. Major decisions should be made through a statutory policy committee involving relevant government agencies. So my final slide is the coexistence with the deposit tokens. This is what Bank of Korea think about how we can complement stablecoins with deposit tokens. Bank of Korea has also accumulated significant digital currency expertise, including through the project Hangang. One takeaway from these experiments is the potential of deposit tokens, which is blockchain-based representation of bank deposits. Deposit tokens can offer many of the same benefits as stablecoins while preserving transparency and preventing capital flow circumvention. For this reason, Bank of Korea sees deposit tokens as a strong complementary tool, possibly serving as a backup to privately issued Korean won stablecoins. To conclude my presentation, central banks and policymakers must continue hard to ensure that stablecoins do not undermine monetary and financial stability. Stablecoins could become a key that unlocks new possibilities in global finance, or they could become the source of new vulnerabilities. The real question is how we build trust, not just technology. Bank of Korea hopes to work together with the ASEAN Plus 3 community and with the private sector to design safeguard that enables innovation while preserving stability. I'll stop here. Thank you.
Thank you very much, Minzu. That was not only a great introduction to an important issue in the ASEAN Plus 3 financial landscape, but I would also say just a fantastic primer on stablecoins. So I think we're all very privileged to hear that. Now we're going to move on to hear from the private sector. Just before we do that, I'd note if you have questions for the panelists, now you should go ahead and start submitting those. As Minzu was talking, they were just rushing in, so if you have questions, get ahead of the queue and start putting them in. Alicia, I'm very interested to hear what do you have to say here. What do you have to say from the view of the private sector on the financial landscape?
Thank you. Well, you gave us a lot of homework, lots of questions. I'm going to try to pull them together. It was about financial fragmentation, Global financial fragmentation, are we there, are we not? Where is Asia in all of this? So I'm going to try to address those questions. So I'll perhaps summarize what I'm going to say with this idea of Asia's financial paradox. And what I understand by paradox is that 20 years down the road, and this is the time I've been in Asia, kind of I started with global imbalances and I end with global imbalances, yeah, and that's where we are. So for the last 20 years, and it is even more true today, Asia has been accumulating current account surpluses. We have economies out there with 15% of GDP in a current account surplus. That's Taiwan and many others. You have Vietnam, huge current account surplus. So when we look at that for an economy that basically contributes the whole of Asia to half of global economic growth, you may understand that, okay, the logic of this is that we have outflows from Asia, which is true. 2025, up to date, we have huge portfolio outflows from China, notwithstanding a very good stock market performance, generally from ASEAN. A little bit of FDI into ASEAN, but overall, basically, outflows. And the question really is, so this is net outflows. So you say, okay, this makes sense. We have, surpluses, real economy surpluses, notwithstanding Trump's tariffs. So everything is back to where it was 20 years ago, just bigger. But the difference is that there's been a lot of efforts, in at least gross-wise, maybe not net-wise, to have those older, rich, capital-rich, saving-rich Asian countries invest in the rest, in the high-yield ASEAN economies. But when you look at the numbers, you don't find that that has actually been confirmed, except for FDI, but even not for the bulk of it after 20 years. So that's what I call the paradox. Why not? Many institutions in the room have tried very hard with different initiatives, Asian Bond Market Initiative, Asian Chama Initiative, you name it, and we're still here. And really, it's really a paradox for me. At the same time, we have also had, of course, among all of these Asian economies, kind of an outlier, if I may say so, in terms of economic power, soft power, you name it, which start to be reflected in the currency. This is obviously the RMB. You have a new, 2015 already, not so new, international payment system, CIPS, growing massively. So, you could argue you have the seeds, but it's still, we just aren't there. At the same time, and increasingly this year, we start to all discuss this potential de-dollarization, or at least slow dollarization, if I may say so. But the numbers don't really confirm that. We have 90% of Forex transactions in dollar. We have 50% of SWIFT transactions in dollar. And we have an even faster growing financialization of the US than even Asia, by all means. So we have around 100 trillion in total credit assets in the US and around 50, half in Asia. What is most interesting is that when you look at what I call mature assets, so banks or, the difference is actually converging somehow. Where it is diverging is in the new type of assets. Private credit, you name it. So then the question really is, why? I mean, why are we seeing the US still dominating in these financial transactions if the US economy in terms of, in relative terms is shrinking compared to the rest of Asia? So what are the reasons? Is this something we're comfortable with? One could argue, if we've been comfortable for 20 years, why not now? Well, the difference now is that we start talking about potential de-dollarization. So, if you sit on all of these assets, you're a net creditor, maybe, you start worrying. So why isn't this happening? So I was thinking, just by the mere fact that what is growing the most is the least regulated part of the US financial sector, maybe that is one of the reasons. Yeah, one of the reasons is that the US basically moves faster in terms of financial innovation, and increasingly, and this is mostly the Trump administration, financial deregulation. I'm not sure whether this is good or bad, going back to the presentation by the Bank of Korea, but it is something that, in my view, is behind this paradox. That no matter the need and the complementarity of old and rich Asia versus, young and kind of high return Asia, you still miss the assets, kind of the dynamic assets, the liquidity, the innovation that you find in the US system. And that is beyond the currency, in a way. So the question is, if Asia is comfortable with this, we're all fine. But if Asia is starting to be worried about this exposure, then the only way out is to move further, on opening up. This is, of course, for some capital account, and this is not only China. I mean, it, in a way, it refers to many other countries, whether it's regulatory-based or not, regulation-based or not. So is Asia ready for this? Is Asia ready to kind of come back and bring capital back into Asia with what that means? Because it will have consequence on the real economy, on those imbalances we've been talking for 20 years. But maybe this is the time, because we're worried about that exposure. But if that's the case, really, the institutional changes that need to be introduced are massive. And that's just what I wanted to say. Thank you.
Thank you very much for providing that really nuanced color on this real fragmentation, financial integration story that we've been talking about. And I love that phrase, Asian paradox, was it? I think that's what I think that we'll be taking away with us today. Arup, let me hand over to you for your thoughts.
Good afternoon. Thank you, AMRO and Dan, for giving me this opportunity to participate today. I'll look slightly at the brighter side of things and would try to address two questions. What explains the resilience of ASEAN?
Arup, I think we have a microphone there.
Sorry. Good afternoon. Thanks, AMRO and Dan, for giving me this opportunity to participate in today's forum. I'll try to look slightly on the brighter side of things, and my learned panelists have already spoken in detail. So I'll add a few points and summarize and address two questions. First, what explains the resilience of ASEAN plus financial markets? What has changed? And second is what more we can do in terms of the prospects for deeper financial integration. So starting with the first, what we have observed is the regional economies have been much better and proactive in terms of securing FX swap lines with major central banks in the region. And that has been providing the backstop during external vulnerabilities. Second is, a lot of the central banks in the region have learned lessons from the previous financial crisis, and they have been building up their FX buffers. If you look at the FX reserves number, we have seen a tendency to build the reserves during a weaker dollar environment. Here, I want to highlight two separate things. If you look at FX adequacy, the first is rising import cover. But we have also observed the second factor, which is reducing the dependence on short-term debt. So in some of the countries in the region, we have seen a preference to issue more longer-term debt or to extend duration or increase the weighted average maturity of existing debt, as well as pursue debt switch program. So all of these basically reduce the refinancing risk of the countries during times of external vulnerability. As my learned panelist already mentioned, we have seen Asia's current account surpluses improve. Most of the economies are running large current account surpluses. A few are running smaller deficits, which basically reduce the reliance on foreign funding. Here I want to highlight the difference between Asia and LATAM. If you look at foreign ownership of local currency debt in Asia, it's mostly less than 20%. In fact, it's between largely 3 to 15% with a few exceptions. Whereas in case of LATAM, you would see the foreign ownership of local currency debt is much, much higher. So talking to a lot of investors, we understand that the reason why they invest in Asia is not because it's a high-yielding market within the EM context, but because the FX volatilities are much lower. So, they have more conviction in investing in the region, even on an FX hedged basis, because they know the central banks have more ammunition to prevent FX volatility during times of stress. I think one difficulty for the countries in the region, and what we have observed particularly after Trump came in as president, is FDI outflows as part of the US trade deals, as well as retail equity outflows. I'm sure BOK would be well aware of it. In case of Korea, despite running very strong current account surpluses, we have seen this theme of FDI outflows to set up manufacturing facilities in the US, as well as retail equity outflows that have put pressure on the currency. In terms of increasing the resilience of local currency market, a very important factor is, I think it was mentioned in one of the prior presentation, is the participation of local NBFIs, particularly insurers, pension funds, and mutual funds. So we have observed that these investors, which are more sticky in nature, are increasing their investments in local currency market. And that has reduced the dependence on foreign funding. Two of the countries, one is Korea, of course, is going to be part of the WIGB index, and we are also hopeful that Philippines would also get part of the GBI index. So these potential index inclusions actually attract more sticky EM benchmarked money into the region. Now, moving on to the dollar story, we think it's important to differentiate between the cyclical weakness in the dollar and the structural story. Now, what happened in the first half of the year is there was a lot of pressure on US companies to stockpile their inventories. In other words, front-loading their imports, and Asia being largely an export-dependent region, it benefited from front-loading of trade and exports. So that was one of the reasons for the dollar weakness. The second was, of course, Fed rate cut expectations. However, as it was shared in a lot of the presentations, the structural de-dollarization story is overblown in our view. The reason is because when we speak to a lot of the foreign asset managers, they say that they have hedged their dollar exposures, but they haven't reduced their dollar asset exposure. In other words, it's more of an FX hedge rather than reducing the risk of the underlying securities. And the second is, if you look at, I think it was mentioned in many of the comments that the share of dollar in cross-border payments is still quite large. So it's more of a cyclical weakness in the dollar rather than a structural shift away from the dollar. Trying to move to the second part, what can we do more in terms of the prospects? There has been, of course, much progress in supporting cross-border payments via fast payment systems. We know about the QRIS in Indonesia. In Thailand, we have the Prompt Pay. However, these systems are more country-specific. So the authorities can actually come up with a more regional application that can house various QR codes and systems that will help travelers and foreign workers to meet their FX needs for spending or remittances. We have also observed this phenomenon of lot of intra-region tourism. I mean, if you look at some of the tourist hotspots in the region, we observe that there are a lot of inflows from Asian tourists into Asian countries rather than depending a lot on overseas tourists. So that's also supports the FX needs for tourism purposes. As we understand at the regional level, ASEAN is also moving forward with a regional payment connectivity via an ASEAN-wide QR code. Having said that, as was mentioned, there is need for more cybersecurity and AML monitoring. Finally, these initiatives can be scaled up further so that not just they meet the requirements of travelers, tourists, or foreign workers, but also corporates can settle their outstanding balances, payments in local currencies rather than using the US dollar as an intermediary that adds cost to their process. And of course, we would prefer to have less FX mismatch, both tenor-wise as well as currency-wise. So to summarize, Asia has been vulnerable because of the US trade tariffs, particularly after the Liberation Day. But if you compare with other emerging markets, it has definitely fared much better, both in terms of the local structural support as well as reduced FX volatility. But going forward, it would help if ASEAN +3 can widen the digital payment systems into a region-wide framework rather than just being country-specific. I'll stop there, Dan, and pass back to you.
Thank you very much, Arup. And I think that message about regional financial resilience is a very important macro story for the region, over the past 6 months or so. Now, we'll move on to the Q&As. Just looking at the ones that have come in, there are a lot on stablecoins. So what I'm going to do is I'm going to ask a few questions. We'll take the ones that are not about stablecoins first, just to make sure we cover a few of those, and then we can answer all the stablecoin questions that people have. So let me start with one of my own. Now, when we think back to April, so 6 months ago, there was a lot of talk, given the events there, that we were at something of an inflection point for the global financial system, and that we could expect to see large shifts in portfolio allocations, long-lasting change in cross-asset correlations, as some previous safe haven assets were no longer perceived as such. Looking 6 months down the track, at least looking at equity markets, you're not really seeing any of that. So my question to the panelists is, have we actually seen any persistent changes in financial market participant behaviour due to the events in April? Or was it really just merely a temporary blip the markets have moved past? Now, to be fair, I'm going to go in the opposite direction this time, but Arup, I'll give you a bit of a break. Alicia, do you want to come in on this one?
Yeah, I think we've seen a few changes beyond, of course, the increasing role of stable coins, but also hedge funds in the US Treasury market. I think that's important also. Europe much more invested in the US than it was in portfolio flows. That's also important. So I do think that there's been quite a lot of relevant changes and we've not even talked about what is going to happen next year, which is all of these commitments to invest in the US probably being deployed. So, looking at all of that is, in a way, what is missing in that picture. So if you think about, stable coins, hedge funds, Europe in the US, and FDI, mostly from Asia and Europe into the US, again, we're missing the liquidity pools in Asia, going back to my point, that would develop those, safe assets that you need to you yourself develop those stable coins that would compete with those in the US. So in a way, what I think I'm missing, and hopefully 2026 we'll see more of that, is those liquidity pools in Asia. Yeah.
Okay, so we're seeing something, but maybe it's a little bit below the surface, and some other developments have to happen to really give it a kickstart. Arup, do you have any views on this one? And I should say, for panelists, feel free. We have lots of questions, so if you'd rather move on, we can. Minzu.
When you looking back at the April and this Liberation Day, I think it was about time when we had a ASEAN +3 deputies meeting at that time also. So yeah, at the time there was a huge shock to the market, and I think it's because of this policy changes, mainly in US, regarding trade policy. And this kind of uncertainty shock gave a big shock to the market. And when you think about it right now, it's not like a break of system when you look at it. But the shock that came at the time was inevitable when you're looking back, because at the time the market was somewhat stretched also. Because when you look at the equity valuation, and there was also worry about inflation concerns, and also big worry about physical deficits. So all this combined, I think it was a shock that broke what we've been used to for many years. Like, those safe assets didn't act like safe assets at the time. But I don't think it's just a noise now. I think it's a gradual change going forward to this, not break of the system, maybe change of the system. So I think it might be a warning sign. So I think we need to, look after for the next some shock, which if then gives the same, correlation, that uncorrelation, or that we are not used to, then I think we need to consider this issue more deeply and be concerned.
Thanks a lot. And I think that really comes back to the resilience point. It was a very large shock, but the financial systems in the region were able to adapt to that. And maybe that's why we haven't seen such visible effects as one might have expected. Zeno, would you like to come in on this?
Thank you, Dan. Maybe just a few quick items to share. For the part of the Philippines, what we have observed is that with the uptick in uncertainty, both in terms of trade policies and those related to geopolitical tensions, we've seen some initial outflows from financial markets, but that was relatively short-lived. We have seen inflows, but the composition has changed. For the equities market, the inflows were relatively slow in coming, but there were more inflows going into the domestic government securities market. And some of this may be related to the monetary policy cycle that was adopted since last year. And also, to some extent, the interest in GS also was driven by domestic investors. I think pension funds, insurance companies have found GS to be attractive in the current environment. We have also seen, in another dimension, flows in terms of foreign direct investments. And here, some of them continue to be driven by perhaps longer structural trends, investments on renewable energy, investments on electronics as they prepare for the growth in the technological cycle. But there are also those that are related to trade diversion effects. So we've seen some interest, some initial flows that are related to that, as some companies tried to diversify their sources in the supply chain. And that's also something that we have observed, both in terms of actual inflows as well as inquiries since the second quarter of this year. So I stop there.
Yeah, I'll add a few points. I think it was mentioned in one of the earlier presentations on hedge ratios. I think it's part of a feedback loop that when a pension fund or an insurer or a corporate thinks that the dollar is going to remain strong, there is a very high bar for converting the dollar into local currency. In fact, what we observed earlier this year in case of Malaysian ringgit, because the corporates were repatriating back, the ringgit actually ended up being one of the best performing currencies in the region. If you look at Korea, the hedge ratios of some of the pension funds are very, very low. And that's part of the reason why the Korean won is weak, even though the economy is performing very strong. And finally, in terms of Asia's strong point, in terms of negotiations with the US, where Asia benefits is its first is of course going up the value chain, and second it's a predominance in some of the key industries like AI, HBM, ship manufacturing, semiconductors, and that gives it a lot of leeway in terms of discussing with the US. And if these NBFIs or the corporates stop having the feedback loop of a stronger dollar, and the money, part of that money can be brought back into the region and invested, we have seen what that can do to FX stability in the region.
Thanks a lot. And I think that leads very, very nicely into the first question from the audience that I'll pose to the panel, which is the perceived resilience of ASEAN financial markets over the past decade or so a function of a benign global environment, in other words, largely good luck? Or is it the result of fundamentally stronger divestment of domestic policies, domestic institutional structures? And so, given a very large global risk-off shock, how should we expect financial markets in the region to react? Would anybody like to take that? Minzu?
I think, Asian countries, we've been gone through like crisis, like a couple of times, Asian crisis and global crisis. So I think we put up with good measures, policy measures to prevent this kind of thing happening going forward. So up to now, being resilient is, I think, because of those kind of measures. But what I'm observing nowadays is somehow the structure has changed. For example, Korea, like Arab mentioned, we have a significant current account surplus nowadays. But our exchange rate is going up. That is, Korean won is depreciating. The reason for that is that our pension service is investing heavily overseas, and also our domestic investors are also investing heavily overseas. The reason for that is, I think, one of the policies that we put in through took part. That is that in order to prevent future crises, in the past, we put policies to prevent foreign investments from coming in too much. But nowadays, I think we need to reverse this policy because too much outflows are going abroad because of obvious reasons. The pension is growing significantly, and our domestic market is relatively small. So if the pension fund invests everything into our domestic equities market, it will have a significant impact to it. And so they diversified into overseas markets. But since they're growing, they're investing significantly, heavily overseas. And initially, they wanted to hedge. Our hedge ratio is somewhat low is because still the domestic hedging market is relatively small. So pension funds, they invest long-term investments, but they cannot hedge, long-term. They need to roll over short-term hedges over and over. So that's giving pressure to the domestic swap market and also FX market. So they decide not to hedge. And with this dollar strength and US exceptionalism, it works somehow. But exchange rate is going over the level that we think we didn't experience unless there was a crisis. So in general, public's mind, they think that when certain level goes over, then there will be a crisis. But I don't think there will be a crisis because the landscape of our assets overseas and liabilities overseas has changed significantly since 2014. Now we are about a huge creditor to overseas. So even though the exchange rate goes up, it's not like in the crisis that our overseas liability is going to be problemsome. So instead, I think it's going to have some more income effect for people who invest heavily overseas. So I think actually Korean government and Bank of Korea is promoting more investment into Korean financial market. We're deregulating FX regulations. We have opened our FX market to 2 a.m. and now we are pushing for 24-hour trading till next June. And we've been included in the WICB index. So starting next April, huge inflows from those passive investors that follow WICB index will come in. And also, we are also pushing for the MSCI index inclusion. In order to offset these huge flows overseas from domestic investors, we would like to invite more inflows to domestic market from foreigners. So I think this is a structural change that we observe nowadays in Korea.
Arup?
Yeah, I think a good case study is Thai baht versus Korean won. In the third quarter, GDP, Thailand was weak, it was negative. Tourism is slowing down, inflation is negative. Even then, the currency has been strengthening because they are not able to recycle. And there is a strong home bias in Thailand. If you talk to the pension funds, the insurers, they invest in local currencies. So the assets are local money market funds, local equities, local bonds. So the excess liquidity gets recycled domestically. So despite a weak economy, despite slowing tourism, because of the gold correlation, Thai baht has been very strong, and the authorities are actually trying to weaken Thai baht. On the other hand, if you look at Korea, the third quarter was very strong, and I'm sure you'll be looking to upgrade your GDP forecast in the upcoming meeting. Even then, the currency has weakened. So that basically tells us how important the local NBFIs and their bias towards US dollar assets versus local assets that decide the future direction of currency.
Alicia, and I think Zeno, you want to come in as well, is that right?
Maybe just to...
Maybe let's go with Alicia and then we'll come back.
No, actually, the Philippines is on that side too, so I'm sure it's going to be interesting. But I want to add the case of another hedge-reluctant economy, which is Taiwan. And because I think that makes exactly your point, but I think multiply by several times South Korea's case, in the sense that you have, and it is great to have all of these foreign assets. I agree that you're enjoying the kind of the local currency value of all of those net assets. But there is somebody intermediating this, yeah? And in the case of Taiwan is this insurance companies, yeah? And the fact that through, that intermediation is happening without enough hedging is a big problem. So in a way, this brings me back to what I was trying to say at the very beginning, that, and I'm very happy that South Korea is doing this, is that really you need huge deregulation of forex, of the forex market. I mean, Taiwan is like, again, 1,000 times more in need, because if not, any of these big swings, and especially with weaker than currencies weaker than equilibrium, Taiwan is a much bigger case again, it is quite scary in terms of the impact on solvency ratios for these insurance companies. So in other words, it does require again a growth of this domestic market, not to pull all of these eggs in the US basket, because whether it's cyclical or not, it still has a huge impact. So I think I'm just going back to my first point, for again, like increasing the pool of liquidity, but also deregulating, especially the forex market, so that hedging is cheaper, especially for these economies needing to put the money overseas in the US market. Yeah.
Thank you very much. Zeno, would you like to come in?
Maybe quickly, Dan. So for the Philippines, I agree with DG Minsu that the previous experience, the past 30 years, have been a learning experience for us. We've undergone through several challenging periods for the banking system, and both the private sector and the regulators have learned from that. and practices have been improved. On the regulatory side, there were also improvements in the regulatory and supervisory framework. Maybe perhaps another aspect will be the reforms, particularly when we opened up foreign banks more than 30 years ago, and that improved competition. It also introduced better practices in private commercial banking, and that has contributed to the resilience that we have observed in recent crises. Now, in the past 2 years, the other side of the financial system, outside of the banking system, we are pushing for capital market development. And one way that we have done so is through the back door. We're looking to improve the money market with the central bank introducing more market orientation in its operations, and that has contributed to the building of a benchmark curve that could go all the way to the longer tenors. And so we think that there's a lot of activities there, improvements in capital market development. We have improvements in the taxation over these instruments. The benchmark tenors have been identified, and that's why we're hoping we could be included in the bond index, hopefully sooner than later. So that has also helped keep the interest of the market on the Philippine financial market, despite all these external shocks that we're going through.
Arap, do you have a quick intervention, because I want to get to stable coins as well?
No, I just wanted to highlight, in case of the Philippines also, one important point is non-monetary policy tools. So because the rear was strong, so therefore the central bank can continue cutting rates. So it's important to use non-monetary policy tools like macroprudential measures or housing market regulations or FX interventions, so that the FX and the rate policy can work separately. I'll stop there.
Thanks. So that was a great question. It really touched a nerve with the participants, I think. The message that I take away is, yes, these financial systems are more resilient, but financial markets are very interconnected, and they change over time through technology and other reasons. And that means that financial reforms and bolstering financial system resilience is not a one-off policy change. It's a continuous process that has to match the changes in the financial market environment. If I could just add one point of my own, which is to say that the way in which you evaluate the severity of shocks is not to look at whether you're at a crisis or not. One of the reasons these economies haven't had crises is not because they haven't had big shocks. There have been large shocks, but the financial systems in the economies are just much more resilient. It's the way that many buildings in this region are built to withstand very large earthquakes. Whereas in other regions where the earthquakes are not so large, even a moderate-sized earthquake can lead to large damages. Now we have a question from the floor. Bob, please go ahead.
Yes, thank you, Daniel. I just wanted to make a little coda point on this FX hedging, and there's a cyclical element at work here. If you read the Treasury Fed foreign exchange report for the U.S. from 1985, mid-1985, there's an allusion to the fact that during the dollar's run-up to its peak in early 1985, that the hedge ratios around the world had systematically come down in a kind of Pavlovian process, where if you were the outlier who hedged less, your institution did better, you got promoted, and so on. And then when the thing turns, you get a lot of just kind of rush back to the benchmark, which had been kind of cheated on in the interest of a profit, which was kind of reinforcing. So I think part of what we're seeing, the sharpness of what happened in the spring, had to do with how long the dollar had been on average going up.
Thanks, Bob. And it's fascinating that these issues that seem so novel and salient now, in fact, were actually ones that people were grappling with so so many decades ago. Let's move on to stablecoins. We haven't got a lot of time left, I'm afraid, so I'm going to try and combine some of the questions that have come in into a small number. Look, one set of questions I think I can summarize as, what do you see as the use cases for stablecoins in this region? Do you think that stablecoins or their use will be material, or will they remain on the fringes of the payments ecosystem? And what do they mean for the use of local currencies, particularly in cross-border transactions in the region? Minzu, would you like to come in on this one?
Okay, yes. I think, stable coins, it makes you, transact more easily and cheaply. So the innovation aspect, there's plenty of opportunities. But still, when you look at it, the stable coins currently issued is mainly dominated by dollars. So for the region, I think here is only a beginning stage. So, for example, the why Korean won stable issuance problem is buzzword in Korea is that, our cultural, K culture, music and drama and the items deriving from those cultural things. Those people who want to issue Korean won stablecoins want to sell those items in stablecoins. So they say that they can find some sort of a niche that foreigners can buy easily using stablecoins when Korean won stablecoin is issued. Because for now, there's still regulation regarding internet transaction of credit cards, because you need to identify yourself or put in your ID numbers in order to buy items from Korea. So that's their push, but still we are in a very beginning stage. So that's why Bank of Korea wanted to promote this innovation, but still wanted to have it done properly. So we don't want to have another crisis. We don't want to have another coin runs. So we want the bank to be involved because there can be a backstop. But still, because currently the stable coins are issued by tech companies, private companies, that doesn't have full backup when crises arise. Normal times is okay, but you have to think about the bad times.
Thanks a lot. Any other participants want to weigh in on what they see as the use cases of stablecoins? Zeno and then Alicia.
Yeah, thank you for that question. For the Philippines, there have been a lot of proposals actually from private sector to introduce stable coins in the Philippines. A lot of them are dollar-based, but there was one or a couple of them that are actually Philippine peso-based stable coin. And the proposals that we hear are primarily driven by possibility of cross-border retail transactions. This could include retail remittance or even transfers and payments. Some of the proposals also focus on the domestic use case, again for the very same thing, retail payments and transfers between local accounts. And we have actually gone through an exercise, a pilot. We have them in a sandbox where we can learn, study how this technology could actually work in the real world. And so far in that limited sandbox activity, they have shown that there could be indeed gains in terms of having cheaper, faster, more efficient transactions for retail users. But we're very careful. We're watching what players are introducing, what they have in mind, what other jurisdictions like BOK has experienced. We're looking at the same dimensions that DG Minsuk has mentioned about the robustness of the reserve backing of these coins, the risk of the pegging, the transparency, the vulnerability of these innovations and help protect the consumers. We are also looking at transparency practices on the legal and regulatory contracts involving these particular transactions. So it's early days for us too. We're trying to learn from both the industry as well as the experiences of other regulators.
Thank you, Zeno. Alicia?
Yeah, so I just want to, I think the best way to summarize what I want to say is to read Lucrezia Reichlin's op-ed on Project Syndicate, whose title is basically "Stablecoins are unavoidable." And I can only tell you that that was kind of on the front, on the table of European ministers at the ECOFIN, our kind of reunion of ministers at the EU level, because we are struggling with this as well. Yeah, that kind of dragging our feet in Europe. Okay, should we do this? Should we not do this? Also on the back of a potential CDBC, so euro digital currency. The reality is this is unavoidable. And I think beyond, of course, how to design it, and I'm not in the best position to discuss that, and protecting consumers, macro, pro, you name it, I think what is very clear is that this is sucking savings away into the US. That's what is happening. This is Europe, this is Asia, this is everybody. And beyond whether this is the right time or not, and this brings us back to structural developments on the dollar, the thing here to realize is that it can be extreme, that we are only at the beginning. And because of that, I think there's no option but to rethink this at the local currency level, meaning Asian local currencies, same for Europe. Whether you can do this maybe in a coordinated way to reduce, to have more stop the risk, maybe in a coordinated way, I don't know. But I think we can't wait forever. This is what I would say even to European players in this field on the regulation side of stablecoins, because it can be much faster than any other financial development ever seen. And that's a risk for the world. And by the way, and I end, for global imbalances, because it's only making them worse rather than any better. Yeah.
So we have just 3 minutes left, but there's one more question from the audience that I'd like to ask you. Again, on stablecoins, do you see financial stability risks coming from these, even if they are fully backed by reserve assets or some kind of high quality liquid assets? It's a tough question. Does anybody want to take it? Minzu?
Yeah, it is. So this high quality reserve assets, meaning also central bank backing, or without central bank backing?
Let's say without central bank balancing. It was backing. It wasn't explicit in the question.
Okay, so then I think the pegging can break. So even though you have these reserve assets, I can break, even though we've seen this incidents, as I mentioned in my presentation at the Silicon Valley Bank incident. So that's why Bank of Korea thought about this tokenized deposit, which is backed by central bank as a reserve to this stablecoin collateral. So then I think we need to have this kind of institution framework that can really act as a backstop without only the private sector back it with their reserve assets, because asset prices can fluctuate at any shock that can make the value decline instantly. And of course, and we are using all cell phones nowadays. And when there's the holders of this stable coin want to redeem their coins instantly, then it can have a significant coin run instantly, and nobody can. I think no private company or tech company can backstop this.
Zeno, would you like to come in?
Yeah, maybe just quickly, there's a promise that it will be 100% backed by high liquid quality assets. But the question is, can we enforce it? Can someone monitor it? Can someone enforce it? Is the governance structure there? Is there a transparency mechanism attached to it? So probably that's also another layer of question when we look at the robustness of these innovations. So I'll stop there.
Alicia, Arop, anything you would like to add? Okay, so again, my screen is flashing red. If I can just, I think, summarize my key takeaways from the panel, I think there were three. One is the ongoing resilience of the region in the face of what I think have actually been some pretty significant financial and economic shocks over the past few years. The second is this dichotomy that we've talked of several times today between real fragmentation on the one hand and financial integration on the other, but which I think something that I think came out very nicely on the panel is that financial integration, yes, but in a very complex way. And I think this Asian paradox idea that Alicia brought up, I think is a very powerful one. There's underneath the sort of the headline financial integration, there's a lot of changes going on, and it's important for financial policy to keep pace with that. And the third message was definitely about digital payments and the developments there, where I think what I took away is we don't know where the end state will be. So it's important for public institutions to be proactive and move with the times so they don't get left behind, but at the same time to be nimble, because the technologies that we think might be the ones that will end up in heavy use in the future, it might turn out to be something very different. So that's the end of the panel. Apologies to people whose questions didn't get answered. There were just far too many, and these panelists were, I think, far too interesting to get through them all. But could you please join me in a round of applause for our panelists?